I think that the economy calls for interest rate cuts. I think the economy calls for large interest rate cuts to get monetary policy to neutral as quickly as we can. Monetary policy is exerting, restriction on the economy. It's holding the economy back. It's pushing the unemployment rate gradually upward, and I don't think that's appropriate given the economic outlook. So I think it's the right thing to cut interest rates rather quickly.
The chorus for more Fed action on rate cuts is growing so loud that it's going to be hard for Jerome Powell to ignore all those cries, because it's one thing when a Trump-appointed Fed governor, Steve Myron, is calling for a hefty cut, but when Powell's own allies are peeling off, it could go from a rift to a revolution. San Francisco Fed President Mary Daly, who's usually in line with Powell, just told the Wall Street Journal that it is time to cut. Now, that is not subtle. The Fed is deeply split. Now, in addition to Myron, you've got Bowman and Waller, who are also in the cut camp. Daly is saying it's time for a cut. John Williams, New York Fed, another Powell ally, also saying opening the door for a cut. Let's put it that way. So, Luke, to Taylor's point in the A block, and we were talking about it a lot yesterday, is this market going to get its 25 beeps or not?
Yes.
Okay.
Yeah, I was also wrong last year about the jumbo cut, so take it with a grain of salt. But
fair.
Look, I do think we're going to get the 25 basis point cut. What really matters is 2026 expectations. So, look, these things change a lot. Last year, around December 2024, we were talking about 2 Fed rate cuts. We're probably going to end up getting 3, like I mentioned. I think this will be the third 25 basis point. But everything is looking at, like I said, talking about strong economic growth. But the worst and the thing we need to pay attention to the most, and they're talking about it a lot more, is the jobs market. And I brought it up before on your show that the AI infrastructure, the AI implementation, that's going to take jobs into 2026. And AI is actually going to help at the margin with all these corporations. Every stock is this tech stock now. It's not just the Mag 7. You're seeing rotation out of the Mag 7 to other names. So my point is with that is, if every company is a tech stock now and using AI, their margins can improve, they can lay off workers, the economy can actually not be too strong, but the actual profitability of these companies can actually remain pretty strong and stocks can do well. So look, we talked before, about tech. I'm staying away from NVIDIA. I'm staying away from Palantir. I think there's a changing of the guard happening at the top, too, with Gemini and Google, with NVIDIA, the news today. So I think there's that market rotation to the equal weight that I've talked about before. Specifically, I know we talked about the Dow Jones Industrial Average. I'm talking about DOW, manufacturing firms, even with a big, beautiful bill that, have the depreciation bonus, now 100% bonus depreciation, and also the R&D expensing. I think that's where you want to pay attention to from an investing allocation.
This is really interesting, and I just like the way you put that so simply, that what could be good news for the markets, which is the AI productivity, earnings continue to do really well. The market gets its rate cuts, which, tends to prop it up a little bit. All while the underlying fundamentals, however, weaken, Taylor, and that is actually a scary prospect.
And therein lies the rub. And Marcus Lemonis is the one as well who has said AI is the reason they should be cutting yesterday, because we don't really know how this plays out in terms of jobs in the labor market next year, as companies are forced to look at the bottom line, right? And be more considerate about how you're using those expenses, and all the productivity gains that comes with AI means inevitably there is going to be some cost cutting. That being said, and I just want to pose this to the table to open up a little bit of debate. If inflation that we just talked about in the last segment is the number one issue for consumers, doesn't the Fed need stable and low prices before they think about the labor market? When we talk about the balance of risks, a lot of people have thought the labor market has to be front and center much more so than inflation. But if inflation is what is the pain point for consumers right now, ought that not to be the bigger focus? No. I don't know.
I would say no, Taylor.
Yeah. Okay.
And just to kind of have this open debate, and the reason being is, does the Federal Reserve talk about AI? Do they even talk about it? They kind of just, every time the AI is brought up in a question, they kind of just throw it to the side. So if affordability is an issue, losing your job is a bigger issue, right? Because you can't obviously afford anything if you lose your job. So I think that job market, and again, I know they don't talk about it, but if my thesis is that AI is going to replace jobs, that's much more disinflationary than anything else.
But couldn't you argue inflation hurts all of us, where losing your job hurts only the people who lose their job? Not to discount that.
Yes, you can. But I also agree with Luke in that if people lose their jobs, then they can't consume. The consumer's 2/3 of the economy. But to your point, I think Powell and other Fed members, and even the market to a certain degree, have tacitly accepted this 3% as sort of the new normal. So I don't think they're prioritizing it. But what do you guys think?
Well, I would say interest rates are the price of money that people pay. So I think when they think about affordability, interest rates are one of the things people think about. The rate I pay for a car loan, the rate I pay for my mortgage, and so forth. So I do think it is part of affordability, and that's one of the prices in the economy they'd like to see come down. I'll just say this. I think it's interesting. If it's true that Daley and Williams are kind of mouthpieces for Powell, I think it's very interesting that he's deployed them recently to talk about bringing interest rates down. And it makes me think, what is he thinking about? And I would say if he's taking the move to send his kind of right and left-hand people out to talk about bringing rates down, he must be very concerned about the job market. That's what I read there. And that's actually consistent with the data I'm seeing. I don't think he would be doing this unless he really thought the risks in the economy were weighted toward jobs deteriorating. We'll see if he says anything about that, but that's
to me, you're saying that too late realizes he was too late.
I think he is very concerned about being too late on jobs. Thank you.
And I think this is an opportunity for small business to catch up, though, because all the large corporations took all the jobs for the past 5 years. So small business, small caps in the S&P 500, if the job market is struggling in a lot of ways, it's a way for these small businesses to take some of the big employers that may be laying them off. So I think it's actually, again, this bifurcated economy that we go into.
Dagan?
So we brought this up, I think yesterday and also today. Why would the stock market care about a 1/4 point cut? Because because the stocks and risky debt need to be the only positive returning asset. So if you have a sluggish enough economy that the Federal Reserve can drop rates, the lower the rate, even if it's by a 1/4 point, it makes all this borrowing and stock speculation make sense. In essence, that it makes it easier to sell the AI debt because it's not AI stocks, it's AI debt now as well, that they are inextricably linked. If the government bonds pay 2.5%, that the valuation issues haunting tech stocks don't seem quite so scary if rates are 3% and inflation is 3%. So safe investments don't return anything, then the only big game in town. Like if safe investments don't return anything above the rate of inflation, then the only game in town is stocks and riskier debt. And your risky debts don't, it's a strong enough economy where the payments are made, the risky debts don't default, and the yields are low enough that the payments can be made. So it's, if it's a 5% on a risk-free government bond, you as the investor would demand, 8 or 9% from your crap AI bonds. But, the lower the rates are on risk-free, the less that these borrowers can pay in the corporate market. So that's why it's good for stocks in the short run and the borrowers in the investment grade market.
I did a quick write-up in my newsletter about how, and I want to be very clear here, I'm not talking about the high flyers like NVIDIA, but as a general way of speaking over the next few years, I think that the equity markets are safer than the bond markets in a lot of ways because of the wealth divide and separation, because of the liquidity in the system. We didn't even talk about quantitative tightening ending December 1st. That's more liquidity coming back into the system from the Federal Reserve, right? So this wealth separation is continuing.
Okay.